The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
With so many people living longer, the fear of outliving your money becomes a reality for many of us. Will I be a financial burden? Will I outlive my money? How will I be remembered? My name is Neil Himmelstein, president of Main Street Planning Group. Please contact me by visiting mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. I will introduce you to strategies that will guarantee you will not outlive your money, that can guarantee you will not be a burden on your loved ones. Through a collaborative approach, we will uncover solutions that offer tax-efficient strategies, lifetime income, and legacy planning, choice, organization, direction, and education. That is the code we stand behind. Contact mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. And listen to me every Friday at 3 p.m. as I host the Main Street Code for Financial Success, right here on 103.9 LI News Radio. Welcome to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. I'm here every Friday 3, and sometimes they play me at some other times. But it's good to speak to everyone today. When we talk about our code, we talk about choice, organization, direction, and education. And we help hundreds of advisors and clients across the United States with regards to life insurance, disability, long-term care, annuities, and life settlements. And in our discussions, we are part of your planning team. And, you know, everybody needs a team when they're doing planning, whether you have an investment advisor, you have an attorney, you have a CPA, and you have an insurance specialist, hopefully. And we like to work with everybody and making your plans work, because everybody's plans are completely different. Everybody's situation is completely different, and everything changes in life. Things change in life every day, every minute, so you need to be flexible in your planning. Next week I have an appointment, referral from an attorney. This couple called me, and they want to insure their 37-year-old for long-term care. You know, they were doing elder law planning with an estate attorney, and they understand and feel the need for long-term care insurance. I mean, I think at this point, I haven't talked to them yet, but I don't know, it would be, if they were to get it, it would be extremely expensive, and maybe their health would preclude them from getting it, but they understand the need tremendously to the point where they want to take care of their 37-year-old. Now, it's an interesting phenomenon, because typically people start thinking about long-term care in their 50s. So I didn't get the call from the 37-year-old, but I've done some planning with long-term care in 30-year-olds and 40-year-olds. Not a lot, because no one really saw the need. And that gives me cause to say from the outset, what are the options of a 30-something-year-old as opposed to, let's say, a 70-something years old? Well, the nice thing is, it's an open slate as to your planning, because maybe they're younger, but maybe there's a reason that person has a health condition, maybe they have some family history that they really want to do some long-term care planning for their 37-year-old. And quite truthfully, we're finding a lot more seniors thinking about their children because of the current economy and everything else. And we can get to that later in the program about how interest rates have gone up again to borrow your first time home. I mean, it's 6.6, 6.7%. It's dramatically, high comparative. It's the highest it's been all year, and it doesn't seem like it's going down, and that's precluding a lot of people from buying mortgages. And the job front for mid-30-year-olds is extremely tight, as the market is changing very fast with AI and openings and possibilities. Things are changing very rapidly. So I see a lot more people thinking about, how do I help my 30-year-olds get to the next step? It used to be 20-year-olds and 15-year-olds. Now we're thinking mid-30-year-olds. Hey, I want to help this person. Well, one thing that you know, if you've ever listened to my program, I'm completely agnostic as to what insurance companies and what plans. I always work with what works best for the client and their needs. So, in this situation, depending on the finances and everything else, if they really want to help this 37-year-old, you need a plan not just for long-term care, but long-term flexibility. So you need a plan. If you're looking at long-term care for a 37-year-old, when will they actually need these services? Well, by percentage, probably when in their 60s or 70s when they would use it. So you're really looking 35, 40 years out. So in doing your planning, you have to say, well, what will the cost be 30 or 40 years out? I mean, right now, you have institutional long-term planning. It's going up 7 to 9% a year for nursing homes. 7 to 9%. It's exceeding the rate of inflation tremendously. It's over, if you need a facility here, whether it's rehab or nursing home, here on Long Island in particular, you're looking at over $15,000 a month or $500 a day on average. Nobody anticipated that. So if I'm really looking at a 30-something-year-old, I want something that's going to grow with inflation, not what currently. So a standalone long-term care plan with an aggressive inflation option may be a solution, but I prefer to have maybe, depending on finances and everything else, to look at more of a hybrid solution of putting money away in, let's say, a whole life that has the availability of having a long-term care rider for the future, but will increase and grow as my client ages, so that we could take care of inflationary things. The beauty of about a whole life is we have a compounding element that's never taxed, with the idea of a long-term care planning growing with this compounding element. So whether I need it for long-term care or whether I need the money for something else, or whether it's a great retirement strategy, which it can be all wrapped into one, or an additional savings vehicle for that 37-year-old who's now, I don't know what their situation is, but is branching out in life, whether they're doing it on their own or their parents are helping them fund something like that. I would want something with tremendous flexibility, something that will have a lot of cash and protection. So planning for a 37-year-old might be quite different than planning for a 60-year-old. The products may be different. The concepts may be different. The flexibility is certainly different. You certainly have greater choices the younger you are. You have greater choices because your health is better. You have greater choices because the expense is lower. But with that, you want more flexibility in your planning to plan for more of the what ifs. So you can't just plan for long-term care. You really have to plan for retirement, long-term care, income. All three things to a 37-year-old are going to be very important. Maybe not now, maybe in 10 years, definitely in 30 years. These are the combination kind of plans that may be better for that person. Again, not knowing that person's situation, not knowing the parent's situation, not knowing the finances, we really have to sit down and meet, because not all plans work for all people. This is where the rubber hits the road, and you really need to plan properly. When we did our senior show last week, as you know or may know, I do two shows. I do the Main Street Code for Financial Success, and I also do the senior show on Monday nights with Tim Kennedy. And one of the things we addressed last week is life stages. How do you plan for a 20-year-old? How do you plan for a 30-year-old? How do you plan for a 40-year-old? What's different? Well, the biggest difference is between 70-year-olds and 30. You have many more options, but the planning has to be done. And the earlier you plan, the more flexibility you have in the future. The problem is we don't know what this world's going to look like in 10 years. We may not know what this world looks like in 2027 with the way things are going today. You're listening to the Main Street Code for Financial Success. I need to go on a break now. Listen, if you need to get a hold of me, best way to reach me is 631-647-4694. That's 631-647-4694. Or you can visit me on the mainstreetcode.com. And if you miss an episode, you can always go on Apple or Spotify and look up the Main Street Code, and you're going to find me on past episodes, and you can keep current even if you're driving around the country. Thank you, and we'll be right back. Welcome back to the Main Street Code for Financial Success. Before the break, we talked about planning for a 37-year-old because we're going to meet with them next week. And it's actually the parents that called us to help us with planning for long-term care for the 37-year-old. I like to look at the big picture and see what else can we do. So we want to look at flexibility of planning. Right now is a very crucial time in everyone's life. For a serious moment, we talked about what's going on in the world. So right now, our interest rates are over. They were at 6.6 this morning or 6.7 yesterday. They're dramatically high for refinancing, for first-time home buyers. And we're seeing this big shift in the economy where we have 30-year-olds, 40-year-olds moving back in with your senior parents, because they can't afford to buy on their own. So a lot of people are upsizing their life instead of downsizing their life. So it's definitely impacting retirement of people that are retired or about to retire, as well as the younger people who want to move on, but are restricted by maybe job opportunities or the ability to buy something on their own. Because of the pricing and the inflation, it's become a very weird economy. In addition, with interest rates rising, and they should continue to rise, we are borrowing as a federal government at an unprecedented rate. Our debt is growing and growing and growing, feeding the war effort. That creates a situation where we have to go into debt. When a government goes into debt, and the number is so fanatical, I think it was 39 trillion last time I looked. But we're paying interest on that debt. The government has to issue bonds. Bonds are debt instruments, unlike stocks. When they issue bonds, they have to make them attractive in the interest rate in order to sell. So they have to sell them at a low price and give a high interest rate. It kind of works backwards. It's kind of weird, you know. So what happens is that drives up mortgage rates, it drives up fixed annuity rates, but it also starts to suck money out of the market, and you will see the market tank at some point this year. I really thought it would have happened already, and the market is extremely volatile right now. I can't tell you how volatile it is. It goes up, it goes down, it's very manipulated, and I'm not saying be scared, I'm saying be prepared. Not scared, prepared. And how do you prepare yourself for these market fluctuations? It's just like if you've made money in this market and you're doing well and you've put away a lot of money, you need to really look at your allocations and what you're doing as far as where your money is. Because, again, the market goes up and down. And now's the time to take money and put it on the sideline and protect it. And what do I mean by that? Well, you have to do what the institutions are doing, and that's putting money on the sideline, whether it's in bond funds or you're listening to Warren Buffett or you listen to these other people. You got to turn your ear off to these investment gurus who really don't have a stake in the game except for their own personal wealth on the markets. So whether you're 30, 40, 50, 60, 70, you need to take time and put your money in some fixed investments. Now, some great investments while you're young, 20, 50, 60, is maybe whole life where you have some safety and surety, with dividends maybe paying 6% that aren't being taxed. You see, you take away the tax element and you'll find that your growth is that much better over the long term, because taxes is your partner every time. So life insurance by its very nature is tax deferred. There's no tax every time you're putting money in. And if you're getting a strong dividend in a whole life policy, or even if you recline to, I love the market, I want to really look at this index market, which is a great option also for accumulating money, and there's no tax. The nice thing about the index is you can track an index and if it happens to go sour this year, that's okay. Because even if we have a dramatic drop, you don't lose any of your money at all. It's a zero floor in most index products, whether it's index life or index annuities. Now, why would we use one and not the other? We can talk about that in a second. But in index life, so in whole life, you're getting dividends every year. And if you have a strong company, they've got a great history of paying dividends through the Depression, through 100 years, very consistent dividends, strong whole life company. And there's 3 or 4 of them in the market right now that have consistently paid anywhere from 5 to 7% dividends forever, almost, with no tax, by the way. No tax, and you take the money out tax-free down the road when you want, not when you could do it when you're 50, 70. It's not for everything. It's not all your investments, but it's a great alternative. It's a great investment in addition to everything else you're doing. Besides, you get the protection for your family, whether it's a living benefit like long-term care or disability, or a death benefit in case you go. There's nothing like it. I mean, it's just the most powerful product, tax-protected product in the world, life insurance. It's fantastic. Index protects you from a downside market, which I think we're going to have, because you have a floor of 0. The downside of index is it does cap you on the top end. So you're not going to get those 30% returns ever, or 20% returns, because you have a cap. Now, index annuities are a little different. There are 2 different types of index annuities. There's what I call a fixed index annuity, which means it can never go down below 0. And in the state of New York, most of them are required to be a minimum 1 to 3%. So you're pretty good there. And you still have the upside potential of a good market. And you have what they call registered index annuities. Those are only offered by those within a broker's license as well as an insurance license, and they're called RILAs, Registered Investment Index Annuities, RILAs. So you have 2 different types of index annuities. I only represent the fixed ones with 0 1 up. I'm not a registered advisor or broker. They're good products. They're all good products. Why would you do an indexed annuity instead of indexed life insurance? Well, quite frankly, you may not be eligible for life insurance because you have health impairments and the carrier won't take you. You may be older, or you may have retirement funds that you can't all dump into life insurance without taxation, but you can dump them into an index annuity and know that your money will never go down if we hit a downplay market. Now, we have a lot of clients that are near or at retirement and have 401ks or pensions or big savings that are in the market, and we highly recommend that you pull back on them and take some or all of it and put in some sort of index product and still get that market participation, but don't have that downside risk. That's where we're seeing a lot of activity with index annuities. My friends are doing RILAs. I'm doing fixed index annuities. Seeing a lot of activity in that market for that reason. And that's why you might want to use that. You're listening to the Main Street Code for Financial Success. I encourage you to reach out to me, even if you just have a question or you want to sit down and talk. I don't charge for visits. I get compensated if you buy a product from me, but I'm always available for advice or questions. 631-647-4694. Also, if there's any ideas you would like me to talk about on the program or have a special guest, I'm wide open. 631-647-4694 or visit me at themainstreetcode.com. Thank you and have a wonderful day.
The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.